Kalimera Siolus Kaikalos Sirtates O Economica. Welcome everybody to O Economica, all about economics and finance. Very happy to be with you all today, and please follow this video. The content today is very interesting. I'm sharing with you my screen, and as everybody can see, that's a plain chart of the pound-dollar exchange rate, and as many people do every day, from the small trader to the investment bank, or they are always monitoring these charts to see the level of interest rate, the level of the exchange rate. And some people do speculation, some other people they use it for macroeconomic reasons, but today content it's special for all those people who can access the data, the pound dollar chart or any FX pair currency chart, and they can only see basically they base their knowledge only on technical analysis. What I'm saying is people who draw lines of some sort, let's say I have a support here, I have a resistance here, and the Bollinger Band is giving me a trend reversal signal. So the content today has been especially made for technicians, and I'm very glad and happy to share with you my content, which by no means is perfect, but I want to share with you what is my work behind the scenes. So what is behind a weekly or an hourly chart of any let's take currencies, and let's take cable, for example. That's the 1 hour chart. Okay, let's take the daily chart. Okay, so basic technical analysis, we can presume some things more or less. We can see a trend and see when it's green, it means it goes up, when it's red, it means it goes down. Or you can do more or less sophisticated things and say, okay, I have an oscillator, the relative strength oscillator, or I have a MACD oscillator, and then I can work with the trading signal of these oscillators, which are basically algorithmic signals that are calculated from the stochastic random walk of the currency pair. So because basically what do we have here is the deviation of the average mean value of the exchange rate. So a stochastic differential equation and a random walk with a Wiener process, it will tell you, okay, let's see if I can so basically in statistics we have in plain statistics we have the average value of something, which is called mu, and we have a sigma or a sigma square. Yeah, sigma square is the variance, sigma is the standard deviation. Okay, so we have mu at time t, sigma square at time t. No, by no means I have the perfect definition, because I haven't read up to now a stochastic calculus or some sort like that, but in broad lines, what happens with the exchange rate, we have a market of traders or institutional traders. They have a bid and ask. They bid for some price, they ask for some price, they bid at the offer, and then they want to buy at some price, they want to sell at some price according to what is the bid ask in the market. And because there is a wealth, a myriad of prices quoted every minute, then we have an average price, mu of t, and a certain sigma, a certain standard deviation, which could be theoretically, I may be wrong, it can be identified with the bid-ask spread or the volatility in itself of the exchange rate. So we have an average value of the exchange rate, and the average value is calculated every 15 minutes, 10 minutes. That is all done by computers, not by human beings. But the basic concept of random walk of an SDE, stochastic differential equation, is that the price that I have now is the average price plus some volatility, some standard deviation at time t, t plus 1, t plus 2, etc., etc. And so the process of the price, we see that we have bars, red and green bars. It's completely random. It's random walk. So basically, there is no, by no means, there is no predictive instruments that can, with complete certainty, can tell you, okay, within the next 10 minutes or the next 10 days, the exchange rate will be exactly that price. So that's the, in very loose concepts, is the very loose words, is the mathematical concept. So that we have an average price and some some volatility, standard deviation in the equation, in the process. So considering that we have an average value of the exchange rate and the standard deviation, we know that there is volatility, of course, that's for all financial assets, and that there is volatility. We can find, I'm trying to to erase this thing. Okay, I will do without. So anyway, when there is volatility, we know that we can see volatility through volumes of trading day volumes, or let's see if, okay. So I don't have the volume bar here at the bottom. So we have a technical instrument which is called volume profile that can be adjusted according to the time frame. And here we are on a 15-minute, for example, and the black bar, so here it says, okay, that's the point, the exchange rate level where there has been the highest level, the highest volume, the largest volume of transactions. So those points are the most per se volatile. So you can have a larger standard deviation, and then by the volume profile you can understand if there are more green bars or red bars, then there is more buy volume or there is more selling volume, etc., etc., etc. Now, currencies, they are normally they are supposed to be not volatile. So they are supposed to be stable. Can I get rid of this? Yeah. So currencies, compared to many financial assets, they are not volatile. They are stable because they are basically linked to the economy. So you cannot have a very volatile currency, otherwise you'll be like Zimbabwe, and you'll have a 500 billion Zimbabwe dollar for going shopping. So, or the Argentinian pesos or stuff like that. So currencies, they must be, let's say, let's all remember that money, they have to be a unit of account, a medium of transaction, and they have to be a store of value. So because of three these axiomatic definitions, these pillar definition, which are unit of account, medium of exchange or transaction, store of value, currencies or money in broad terms, they cannot be too much volatile, but they must preserve a store of value. They must preserve a certain value in order for the economy to work and to assign a price to any goods and services and to labor in the economy. And of course, the price is the historical recording of a transaction in the market that has been carried through by two counterparties. So a price, we think of price as some sort of awful thing because there is a price on anything, but from a sociological point of view, historical, sociological, anthropological point of view, a price basically is the matching of supply and demand, or bid and ask between two individuals in a society, and then they decide to exchange good for some other goods when we are in a barter, or goods for money, for commodity money, at a certain with certain quantities. I mean, I give you a kilo of bread for £1. So we know that price records the historical transaction between it's a sociological happening. So it's a meeting of the buyer and seller, and their interaction in that matter is exchanging bread for money. So the price is not something so heavy, but the price is the historical data of all the transactions that have happened into the economy. So if we consider the economy socially as a necessary thing for the whole society, or a population, or a country, or the global economy to have a meaning, so a price basically represents the interaction between two parties who enter into an agreement of exchanging goods for money or services for money. And the exchange rate, of course, cannot be very volatile, because I cannot quote you a price 100. I cannot, if I go into a shop and I want a kilo of bread, they quote me a price of £1. Then the person behind me goes into the shop and he gets quoted for the same kilo of bread, receives a price. The technical term more significant is receives a price, because consumers, they are price takers, receives a price of £1 and 20 cents. So you have 20% difference between one customer and the immediate following customer. So that's not possible to do if you want a stable economy. That's why exchange rate, they must be stable and not volatile. And that's a very important concept for having a sound financial system and a solid economy. So having made these premises, all this plethora of things, effectively exchange rate are volatile. So that's why we have inflation. I mean, volatility of currencies, it's due to speculation, it's due to supply and demand of big firms, that they need to hedge their import-export currency exposures, and it's the volatility of the pound probably often comes up when the government needs to finance its debt. So when there is fiscal deficit or balance of payments deficits, then the economy in aggregate has to issue more currency to buy the debt or to buy to import more goods from abroad, and then this currency goes into the wider global economy. So currencies can be very volatile, and they can be a source of speculation, of course. I think there are very nice documentaries, I think even from the BBC, about Black Wednesday, when the all the euro Bollinger Band system of currency crashed, the pound crashed, the lira crashed. Also the Italian lira was totally crashed because they presumed that currencies could be fixed within certain boundaries, and basically the Black Wednesday episode was with insight. We know that Germany had to make a lot of monetary effort to rebuild East Germany, and so basically the whole Europe paid with the depreciation of the currency, because they could not be pegged to the Deutschmark, and they could not hike interest rate anymore, otherwise it would have been a disaster. Like the Bank of England had to go to 10-12%, and the Exchequer, the Chancellor, Mr. Lamont or something, it's a very nice documentary. I invite you all to watch it. So that's the chart, and all day traders, they say, okay, I have the RSI here, and I'm going to buy the pound, and I will wait 4 hours. I will make some tiny profit. Let's see if okay, like for example Fibonacci retracements. These are good tools to use, because the Fibonacci series, from a mathematical standpoint, it's a very important series to know. And yeah, we can extend more or less, or we can work with different levels, and you can argue, okay, now we the daily candle has pinched the 61.8 retracement Fibonacci. We are here, and then we don't know, because we are in the middle of the Bollinger Band, and we don't know if we'll go all the way down to 134, or we will go all the way back up again. So like, I mean, I said in the beginning that there is no predictability of these things, because it goes up and down. You don't know what's gonna happen, and it's inbuilt in the mathematical model of the differential equation, because it's a random walk. You know that you have an average value of the exchange rate, and you have a certain time t, and then a time t plus 1 was gonna happen. It's completely random, and there is a bit of sigma or volatility, and then you can figure out or you cannot figure out exactly what's gonna happen, because it's not a deterministic model in this case for financial assets or currencies. So you can draw as much things as you want. You can have like a channel, you have the Fibonacci retracement, you watch the RSI. We are at 49, so we don't know, we are smack in the middle. We don't know if it's overbought or oversold. So what is gonna do? It's gonna go down, it's gonna go up. You have no idea. I have no idea, and I don't have particular interest in these things. But the content today is to show you my work behind the scenes on a larger, on a different scale which is not related to the classic, the ordinary trading chart that you can make nicer. You make a volume profile and say, okay, we have this volume profile, let's find out, shorten the range on the volume profile. We are here, so I don't know, it's a point of control of the volume profile. The market will decide. So there will be a meeting of speculators, and they will decide where the exchange rate goes. So my field of study, of course, is finance, and I deal with these things. All you see here, I learned it by myself, and nobody taught me anything. Not even the university. So if I were waiting for the university, I would be stuck at pen and paper with very little tools to understand the world and the financial markets. So here, for example, we have a big, nice matrices of pound currency pairs annual return. So I took the usual bunch of pound FX pairs, and I asked the machine as usual to show me basically the annual returns for each and every currency pair. And we start from 2004, it goes up to this year, 2025. And I can tell you that the most profitable trade for the pound is not the dollar or the yen or the or the euro. No, it's this one, is that one, GPBZAR. So basically it's pound South African rand, which has a mean return of 4.2%, a median return of 2%. It boasts 14 years of positive return, 8 years of negative return. The best year has returned 27.8%, worst year minus 27. It's completely normal because we have a mean reversion. I said in the beginning of the video, what I say, just try to remember what I say. I'm not totally exact in what I say, but I explained that we have an average value of the exchange rate and we have some volatility. So tendentially we have mean reversion. So if an exchange rate is overvalued or it's undervalued, it tends to reverse or to return towards the average value. Okay, so we have mean reversion of the exchange rate level. And yeah, so best year plus 27, worst year minus 27, we have an average which is very close to zero, which is a standard normal thing. And then the volatility, it's pretty high, it's 13.9%, that's the Sharpe ratio, which is positive and it's good. So contrary to most daily traders, if you want to theoretically buy the pound, sit there and wait, you have to be long pound South African rand, and you will find some very interesting returns. Lately it's been very profitable, the trade with the Japanese yen, because the Japanese yen has depreciated across the board with all the other currencies. So you could sit easily with long yen, and it's fine. So let's see, this year 2025, the outperforming pairs are pound dollar and pound Hong Kong dollar, respectively 8.6% up, 9.8%, almost 10%. The pound has appreciated over the Hong Kong dollar. And also the pound is positive 3 3.8% on the Aussie dollar, and the loonie, the Canadian dollar, 3.4%. And we can see here, for example, that's very interesting. And if you are trading, if you are doing FX trading, this may be interesting for you. So we see here, let's take the row of pound Japanese yen. We see that we have 2021, 2022, 2023, 2024 positive returns, 10%, 3%, 12%, 9%. But this year, 2025, we are half year in, and the pound has appreciated towards the end by a little bit less than 1%. So this could, it's a data point that can make you basically balance out and say, I don't know, maybe I'll have to pay attention, and probably I'll have a big reversal here with the strengthening yen, maybe in 2026. So we'll have like a risk-off scenario and a capital flight into the Japanese yen. And here on the row GBP/JPY, you see 2008, 2016, these big red boxes, minus 40% 2008, so the pound crashed. And so we can understand the dynamics, like when there is a stock market crash, basically you have the currencies that are a safe currency are the Japanese yen and the Swiss franc. So yeah, we see here that, well, more or less with all currencies, but in 2008 you had minus 40% against the Japanese yen, minus 30% against the Swiss franc. And if you are an FX strategist, you can try and have a carry trade with also some other exotic stuff like the Danish krona or the euro or the Hong Kong dollar. So basically, this year, 2025, the pound, it's up 0.9% on the Japanese yen, and it's actually the pound has lost minus 4.2% with Swiss franc. So we have a lot of volatility and differences in the exchange rate between many currencies. We see that we have a theme of depreciating dollar. So the pound, it's up against the dollar, it's up on the Hong Kong dollar, but when we check the safe currencies, safe haven currencies like the Swiss franc or the Japanese yen, the pound has even depreciated, has lost value. So the Swiss franc is stronger than the pound by 4.2%, or it's net unchanged, a little bit less than 1%. This could make you presume, by no means certain, that probably there can be some volatility inbuilt in next year. There will be a change of volatility set up in the market. So for example, in 2026 you will have some trades which will focus on selling the euro, the dollar, and the pound, for example, and then piling or the Australian or the Canadian dollar, and piling into the Swiss franc or the Japanese yen. This could be a theoretical scenario, which is not very theoretical. These are scenarios that happens in periods with high volatility. It can be 2008, 2016, or I don't know, 20, some other periods, which or 2000, the year 2000. So that's a very interesting thing. So if you want to make money, for example, you have to buy the pound against the South African rand, and you will have a lot of green boxes without any major problem, unless it's 2016, it's 2016. So you have to stay away from the pound as far as possible you can get. And yeah, South African rand, the Japanese yen, or the Mexican peso. Now the Mexican peso, so the Mexican economy is an emerging economy, and here the Australian dollar, the pound, is a very hefty return. Best year 18%. The mean return, oh, okay, no. So these ones are those. Let's see, the average return is positive. It's South African and Mexican peso, Japanese yen, Norwegian krona, and Swedish krona. So well, I was saying that the Mexican peso is a very interesting currency, because I believe that not I believe when we take into account the macroeconomic frameworks of Mexico, then we can see that it's a very strong economy, and probably the currency is undervalued. Now, the other side of the coin is that the currency, money, they tend to depreciate. Now, the chart here, it's by no means is a precise representation, because the pound goes back to 1900, so it doesn't start in 2004. But basically, what do you have is that tendentially, here, for example, the nominal trade weighted index value, the pink line, it already shows you some sort of depreciation, going down from 80, 85 down to 60. So in trade weighted terms, when you take the whole exchange rate against all the currencies, and you build a basket with weights, you assign some weights, you can see trade weights. These are arbitrary. They may not reflect the actual trade weight index, but it's to have an idea. Then you see that in trade weighted terms, the purchasing power of the currency tends to decrease with times going by. So when you have the fourth variable, which is time, the time just only goes forward in our world, in the financial system. So then eventually you have a depreciation over a loss of purchasing power in nominal trade weighted, and also real trade weighted index, which is inflation adjusted. You see a rapid downsloping curve, which is similar to having an exponential to the power of minus x squared, like some sort of stuff like that. And so you see that in real terms, the purchasing power of the currency, although it's even trade weighted across many other currencies, it tends to lose purchasing power. So for the same units of currency, you can buy less and less stuff. You get less and less stuff in return when there is a transactions that happens in monetary terms in society. Say an interaction between a people, say a economical expression of social interaction between within a society or an economic system. So we already saw that we are traveling in another dimension, also accounting that the t dimension, the time dimension, only goes forward, but we are not looking at anymore the candle bars, the Japanese candle bars, but we want to know exactly what are other parameters of the exchange rate. So, for example, we can measure the volatility in the long term. So we can measure the annualized volatility, and it's quite simple also. For example, on Excel, if you have a data column of daily returns of any financial assets, you want to take 7 days daily return and calculate the standard deviation for those 7 days, and then you can fill up the column. You have the 7-day volatility. You can take the same value in the next column and multiply the 7-day standard deviation by the square root of 252, so you have the annualized 7-day standard deviation, and you can do that for 21 days. Now 21 days, it's a month worth of volatility, because the market works 5 days a week, so 21 days is effectively 1 month of market activity, of speculative activity in markets. So if and when I want to do day trading, for example, I want to know, I can implement a strategy, and I know that the average level of pound dollar exchange rate, it's 135. Okay, it's 135, almost 136. Okay, but I want to know what is the volatility on the basis of the parameters of the volatility. For example, I can build an effective trading strategy, and the positioning size of and also where is the take profit or the stop loss of the theoretical trading strategy, because I know that the 7-day volatility, it's 0.046, it's around like 4%, and the 1 month volatility, it's 7% for cable, for pound dollar. So if I have an exchange rate that it's a 135.9, I want to size accordingly, and I want to have a position for 7 days. What is useful to have the volatility parameter? I can basically build the positioning size and the stop loss and take profit with a more precise measure, and I know that in 7 days there can be a more or less 4.7% standard deviation volatility. So I can now, I'm not an expert by no means. Let's see if we can have a practical example. Where is that thing that shows you, that annoying thing that shows you the position? Okay, long short position. Okay, let's say I want to buy long here, and then risk reward. So okay, well, it's 0.04 standard deviation, which then you will have to measure in percentages of daily returns, which I cannot do now, but let's try to have a rough idea. I'm adventuring into something which I don't really like. So we calculate the standard deviation, but the standard deviation is annualized. So we know we are planning to have a trade, and the exchange rate now is 1.36, and I have this very funny parameter which is 0.0468, but that is the analyzed 7-day volatility. So in order to know exactly the daily volatility, that I have to add to the average value of the exchange rate, I will have to take the 0.0468 and divide it by the square root of 252 square root, yes, indeed. Okay, and I have a result which is 0.00295, which is approximately okay, let's bring up the calculator here. So 0.00295, forgive my writing, it's 0.295%. So what do I know when doing that? I do know now that in a day, perhaps I can expect that the exchange rate will move by 0.29% or 0.3% more or less. So I can size accordingly, and I don't know. Okay, I'll have here 0.29% is that little, so I can do this, okay, and have okay, 0.29% profit will be here, okay, 0.33, 0.29%. That's for one, it's a daily volatility, daily standard deviation. So okay, if I do plus 1.3607, that's the end result, 136.36. okay, so I can expect reasonably that the exchange rate today will move towards 136.36, but by no means that's a sure thing, okay, because it's not a deterministic equation, a stochastic differential equation, and behind the mathematical model of having these bars up and down, there is human interaction, and most of the time it's algorithm interaction, but by no means we can do a cleaner, having a cleaner strategy of we know what to expect more or less, because I know that according to the past 20 years the average daily volatility it's around 0.3% more or less, okay, and which can be something like I don't know, 40 pips, 50 pips for those who are really, because if I want to know the pips, then I will have to take the exchange rate, multiply by the daily standard deviation, and I have this fancy number which is 40 pips or 40 points that the exchange rate moves, but these are very tiny things which are just for daily traders, but for sure that's a good instrument to have. And I know then the 1 month volatility is 0.07. Now let's pick out the Japanese yen. Okay, today the exchange rate is 199.25 or 27, depends what is the bid-ask spread. It's about 2 yens or 0. No, not 2 yen, even less than 2 yen, 2 cents, I don't know. Anyway, so let's say I want to know how to manage the volatility in pound yen. I know that let's take the 21 days volatility, okay. Okay, still is at 0. Okay, so now by really random reason, pound yen is very interesting. So you can see here that the 7-day volatility, it's higher as an larger parameter than the 21 days volatility. So it means that in the short term you have the 7 days moving average volatility, standard deviation, it's higher than the 21 days standard deviation moving average. Okay, so if we have in the 7 days annualized parameter of 0.0934, we want to divide fraction is by 252, my dear. Okay, so we have 0.00588, which is approximately 0.58%. So we can expect that pound yen on average every day moves by 0.50, it's an awful 58%, okay? And so I can expect plus or minus. So if let's see what is the day today. What day is today? Okay. What day is today, my dear? Very inconvenient. It doesn't want to cooperate. It's horrible 21st century machine. Okay. Now it's cooperating. Okay. So the British way, it's the way to learn things. We know that it will move by 0.58%, so we calculate it now. Exactly, we calculate it now. So that's here, 0.53, 56, 0.58%. Okay, so we know that with some, we don't know anything. We don't presume to know anything. We have a parameter with some reason of certainty. We can estimate, so we don't know exactly, but we can estimate that the exchange rate will drift. That's the term, that's the drift term of the SDE, the differential equation. It could drift to 198.70, and it's within the parameters, the inbuilt volatility parameters of the FX pair pound Japanese yen. Okay, so I will not be surprised that by the end of the business day we will have an exchange rate of 198.70. That means another 50 cents moving down. Okay, so this is I'm giving you a trade live, my dears. Okay, and how do we do that? We take the 7-day JPY pound yen average standard deviation. We take the parameter, we divide it by the square root of 252 days of business in a year, and we approximate, we have an estimate of the daily volatility, which is this nice number. We can take this nice number and we can multiply it by the exchange rate that we see live on the trading terminal on the page, which is 199.28, my dear. And we know that we have 1,000 pips move. No, it's 1.1. Yeah, no, I don't know. Okay, it doesn't matter. So let's forget about it. I think that's a too big number, this one, my dear. Okay, yeah, okay. So I have some serious doubts about these results. Not it is not perfect, I cannot translate it in pips, but anyway, we know that the average standard deviation is half a percentage point, very much closer to 0.6%. So we can calculate the annualized volatility every 7 or 21 days, and we can have some very clear parameters in that regard to estimate the daily moves according, if we are considering a 7 days moving average or a 21 days moving average, which is not the so okay. Oh dear, this horrible machine doesn't want to cooperate at all. This is all very inconvenient. Okay, so when we go on the trading view, we know that we have a simple moving average, SMA. Simple, smooth, because we like smooth things. Smooth moving average, okay? And we have 7 days moving average, but okay, here we have a 7, yeah? Is it that true, guys? Length, 7 periods, okay? The 7 period stops here, yeah? Which is stops here, my dear. Oh dear. Right, stops here, which is 1 full percentage point. By no means is precise, because by means of modern technical calculation, we know that the volatility every 7 days approximates to 0.093, and when we normalize it for daily volatility, we know that it's 0.58%. So the trading instrument of having the 7 periods moving average here, this line here, visibility, I want to, oh my dear, I want to make it thicker. Why you are, okay, you are a very thick boy. Okay, so this very purple line is of no use at all, my dear, because we know that the 7-day standard deviation stops here. Okay, so you will position and size the thing probably wrong. You will be probably wrong, and you will be mismanaging your trades, evidently. Okay, so we can do this work for each and every currency pair that you can. Okay, so now I showed you the 7-day standard deviation moving average. It's not the moving average that you find on a technical chart. It's completely different things. You have completely different parameters that you have to calculate eventually, or you can do some other stuff, but you will not find it on any trading even if you have what is that. Like institutionals, brokers, like interactive brokers, I don't think they have a function where you can see this volatility moving average. So, and then we have volatility ratio. So we talked a lot about this stuff. Let's see what I have to offer. So what I have to offer, well, it's pretty much the same, and I just narrowed the time frame. Instead of starting from 2020 to 2004 or the year 2000, I just narrowed the window in 5 years, so starting 2020 up to now, because it's easier to see the moving average. Just to have an idea, more or less, my idea. A good idea. It's not a good idea at all. Okay, so okay, you can see here the price of the pound South African rand, and the pound basically has gone from 19 to 25. So now any South African has to fork out something like 6-7 rand more to have a pound. So, and the volatility is on the up, but don't be confused, my dear, because when the volatility is up, then the exchange rate goes down. Higher volatility, then you have prices going, or financial asset prices going down. Okay, you have a minus sign in front of the financial assets. And the same is the Norwegian krona has depreciated a lot in the past 5 years, especially from the end of 2022, also here in the beginning of 2020, this upside move. And so narrowing the time frame, it's easier to see graphically the moving average, the purple and the red line, and it works exactly as the moving average in a technical chart. So when they cross, you have an inverse move in the price action. Okay, so let's see what we have more than that. What more do we have? Okay, so we can see we can have a proof of concept when we analyze the autocorrelation, the partial autocorrelation function of currencies. We see that there are no lagged autocorrelation, so the daily returns, they are stationary, and you can run the Dickey-Fuller test, the Dickens-Fuller test, and the Jark-Beer and Shapiro-Wilk test. You have your parameter, and you see if the p-value is statistically significant, and you see that there is no autocorrelation or partial autocorrelation. Here we have a quantiles plot, the quantile chart, and again those dots, the dots here and here, those are very far from the normal distribution on the red line, and so those are the outlier values. That's the price series. So what you see here, this is like a earthquake chart. It's basically is the sequence, the historical sequence of the daily returns, plus 1%, minus 0.5. So you just put it in a row, and you have a chart of this that kind. And the big bar here, that's the Brexit referendum. So you have a huge negative daily return of minus 6, minus 10%. And yeah, the return distribution, it's a Gaussian distribution. It's more or less centered around symmetrical to 0, so it's we can presume it's a standard normal distribution. So currencies in this regard, they don't have very particular descriptive statistics data, except for the kurtosis. And when we basically calculate the expected value of the third or fourth moment of the expected parameter that we want to find, like the skewness or the kurtosis, then every time we have a parameter in the kurtosis that is larger than 3, we have a leptokurtotic distribution. Not distribution, we have leptokurtotic returns. So it means that the distribution has fat tails. What it means that it has fat tails, it has these dots which are very far from the center of the bell curve, as those are the extreme outliers values. So when you have those big days, plus 5, minus 10, those are they are captured in the kurtosis, in the fourth moment of the expected value that we want, the expected estimates of the random variable that you want to find. And okay, very interesting, like pound South African rand has a kurtosis of 2. So that parameter confirms that pound rand, South African rand, does not have very large fat tails, and it's good for carry trade. So you sit yourself long sterling against the South African rand, and there will be some volatility, but the kurtosis is smaller than 3, it's 2.08, so you don't have a leptokurtotic log returns. So it means that you have volatility, but not so extreme volatility. And so that's very interesting. It's these are the small details that you will find when you do quantitative data series analysis of time series, but you will not find it in a daily in a trading chart. And so the takeaway from now, it's for now the takeaway is basically to be long pound South African rand as a carry trade. Now that's another very interesting function that we can find. So we can see the seasonal decomposition of the volatility, and the volatility is decomposed. It's not decomposed. It's analyzed in 4 factors, which is the seasonal component, the trend, and the residual within from extrapolated from the daily returns. So here we have the monthly volatility seasonality. So we have another instrument that tells us which months of the year are more volatile, which months of the year are less volatile, according to the specific FX pair. Now here we have pound Australian dollar. So we see, for example, that October, this box plot, as a huge outlier here with 0.035 standard deviation. So the month of October, for some reason, within the past 20 years of data, it has been very, very volatile. And here the month of July, it's not volatile. It doesn't have any dots outliers, so we can go maximum at 0.01 standard deviation. So we are within range of 1 standard deviation, more or less. And then the same is, for example, for like December, it's very tiny volatility, or February there is tiny volatility, but we have these small circles, dots, which are the outliers of the box plot, basically the statistical outliers of the box plot. And we have the same in quarters. So we see that the third quarter there are no outliers, and we are within 1 standard deviation range in vol. And Q4 can be a lot volatile. We go up to 2 standard deviation, 2.5 standard deviations. And the first and second quarter, they are volatile of more than 1 standard deviation. That's for pound vis-a-vis the Aussie dollar. And here we have the factors of the seasonal volatility. So we have the daily returns, and then we have a trend of daily returns. On trend, the trend of daily returns is between 0.5% up to 1.225%. And then you have a seasonality effect, and you have the residuals. So it's just the residual error noise of the daily returns in the volatility of the seasonal volatility of this daily return. And we can implement this for all the time series that we have. And we can appreciate, for example, that the pound Canadian dollar, it is not the case, my dear, that we will call the Canadian dollar the loonie. There are so many dots, which a lot of lunacy, a lot of volatility. But nevertheless, we will navigate with certainty. But anyway, it seems a lot of dots, but here we are going just to 1.5 standard deviation. There we have to also look carefully at the y-axis here. What are the parameters here? Yes, because if we compare to the, here we have up to 0.03 or 0.035, while the chart here is just 0.016, so that's why it seems that there is a lot of outliers, while it is it's more contained than the Australian dollar. But with this we can have a very graphical and quick idea what are the months which are, or the quarters which are seasonally more volatile or less volatile. And for example, here pound Swiss franc, we have here 0.04 or 4% in standard deviation, or 4 standard deviation in the month of January, which has happened. Some probably was the Swiss franc crash, flash crash. I don't know if it happened in January, but then we see here, for example, in August and September, we have a 0.02 daily return standard deviation, so it's more volatile in August and September. So we are now in July. We can expect more volatility in August and September for pound Swiss franc. And yeah, that's basically for all currency pair. You can see the seasonality of the volatility, and you can build a framework, a reference framework for the work of daily trading or positioning in the medium to long term. You can do a lot of things. So let's see, pound dollar, just to go for something which is more familiar. Okay, pound dollar. So we have August is not volatile. We have September, October. The Q4, fourth quarter, is very, very volatile usually for cable. The daily returns, standard deviation daily returns are very volatile. So you can basically build a trading strategy according to higher or lower volatility, and then you have to size and place your stop loss or take profits accordingly to higher volatility. And that's the same. Okay, we have a chart with the historical events like Brexit or COVID or 2008 or the dot-com bubble, etc, etc, etc. So another quantitative study of time series is the for the conditional volatilities are the GARCH models, which I've spoken about extensively in this channel. I implemented more GARCH models than crumbles of bread in my life, and nevertheless, in this case, in this instance, I also managed to auto-optimize the GARCH models according to the data. The machine did it automatically, optimizing models, and we have some different results, but nevertheless, let's take pound dollar because it's a GJR-GARCH model. I don't remember exactly. These are the names of I will search for the okay, so why the GJR model, it's more complete because it gives you a gamma parameter. So the gamma parameter basically here we are asking the machine or the econometric model to give us the conditional volatility time series, or the conditional volatility of the time series. Okay, so when we calculate the conditional variance and the conditional standard deviation, then the model, the econometric model, gives us some parameters which I've spoken extensively, which are the omega, the alpha, and the beta parameter. And in the case of the GJR-GARCH model, we have also a gamma parameter. The gamma parameter here it's 0.0262, and the p-value it's okay, statistically significant, it's very close to 0, etc. And what tells us the gamma parameter, it tells us how negative shock conditional volatility are amplified with respect to positive shock. So when we have larger volatility, we have a certain gamma parameter result. So the negative shock in volatility, so let's call it higher conditional volatility, they are amplified by 0.0262, which is 2.6%. Okay, in percentage terms, more or less, that would be. The beta parameter is the persistency of volatility, which is 0.93. Let's say that for 1 unit of conditional volatility, you have a persistency of this conditional volatility across time, and time only goes forward for 0.93. So the transmission mechanism of the volatility is persistent by 93%. Okay, and then the alpha parameter is any how to factor how exogenous factors can determine conditional volatility, and it's 3.9%. Okay, so very useful because it tells us what is the best model and the log likelihood, so how well fits the model. The AIC, the BIC criteria, they are very large numbers, so the model fits very, very well. And the mean return are slightly negative. And the daily standard, so strange enough, that's GPB USD. Okay, if we take the daily standard deviation, it's 0.59. Yeah, okay, that was yen, sorry. And the skewness, it's slightly negative, so you have a slightly a marginal preponderance of negative returns for what concerns the pound dollar. And the kurtosis is larger than 3, so you know that you have fat tails like this. Dots here, minus 10%, minus 6%. Those are the fat tails. And conditional volatility comparison, so you have a comparison between the purple line, which is the GARCH volatility, and 20 days realized volatility. So that's very useful by any means, because we know, especially with this GJR-GARCH model, I will read out now to you the Glosten-Jagannath Rankle. Are you rankling something, mate? The Lawrence Glosten Jagannath and David Rankle GARCH model. So basically, on top of the alpha and beta parameters, they introduce another parameter which is the gamma parameter, and which basically the gamma parameter gives you a data that explains the additional impact of the volatility shock that occurs in on any financial asset or series of data. Okay. Well, the conditional volatility, it's a more nuanced set of data to work through. It seems that it's not very useful because the omega, the alpha, the beta parameter, you cannot probably immediately utilize it for trading, and that's somewhat true. But I can give you, I can assure you that if you are trading options, the conditional volatility parameters, it's a must-have, because then you cannot build a Heston model, or you can basically price appropriately the option chain. So we have the GARCH models, we can measure the conditional volatility, and we can build an idea, a good idea. It's not a good idea at all to have a GARCH model. Okay, so let's say analyzing the pound yen. So again, we have a GJR-GARCH model, the Gloston-Ravi the Gloston-Jagatton-Rankle model, or you Rankle something, 1 2 1 2 1 2 1 2 1 2. Okay, so it's the P and the Q parameters, 1 P and 2 Q parameters. So one I don't remember now exactly, but nevertheless, what do we have here? 1 and 2 lags. Okay, so the alpha parameter here, it accounts for 5.9% in pound Japanese yen. The gamma parameter accounts for 7.8%. So when there is a negative shock in volatility, then it amplifies by 7.8%, or by 0.078 units. And the beta parameter here, it's not even close to 9. But now that I'm looking at the p-values, these are not very, they don't fit very well as statistically significant values. So I will take as a pinch of salt, but nevertheless, just for the sake of an example, so here it will tell you theoretically that the persistence of volatility in pound yen, once you have a volatility shock, the persistence of it, it's 0.56, 0.57, or per 1 unit. Okay, so I think, let me double check the Swiss franc. Yeah, here for example we have GARCH model. So the GARCH model does not does not account for the gamma parameter. So the GARCH model, it captures the asymmetry in conditional volatility shocks, but it does not provide a parameter as the gamma parameter to quantify what is to quantify exactly what is the asymmetry in terms of when there is a negative shock, what is the parameter by 5% it's amplified the negative shock in a conditional vol. Nevertheless, the p-values, these are good, and we have a positive alpha value of 0.35 and a positive beta. Here we have negative second alpha value. net it's positive 0, like 0.10 more or less. And we know that like the other, the same as the other pound FX currency pair exchange rates, they have a persistency of volatility which is close to 1 unit. Here it's the beta is 0.98, and the alpha parameter is 0.35, so there is a more, it's a heavier tail in terms of when shock happens, how it propagates in the following periods, and what is the level of persistency of conditional volatility shock across the time series. This kurtosis is huge, so we will go forward. Well, those GARCH models, they are very good indeed. And here, okay, we have the same stuff. I had some okay, yes, okay, so I manage also to have a forecast, okay, days ahead, 63 days ahead. Let's go to the okay, so here I have a forecast of daily volatility, daily conditional volatility, because it's extrapolated from the GARCH models, generalized autoregressive conditional heteroscedastic volatility model. So heteroscedasticity presumes that it's not the error variance, it's not correlated within the daily returns. So anyway, let's have a look. Okay, so what we have here, very quickly, pound Aussie dollar, we have rising volatility. Okay, I said that because these are stochastic equations, by no means the results are deterministic. So if the charts gives me a line which is higher volatility, it by no means it means what it means, that it means what I'm trying to mean to say in the meaning of all things, that it means nothing, it probably means something. It does not determine for sure that there will be higher volatility, because stochastic calculus, it's based on random variables, okay, and the concept of the Wiener process and the random walk. So because the variables we take into account are they move randomly, such as the pound and the Aussie dollar, the chart here has a lineup, okay, there will be higher volatility. That's not for sure, because it's not a deterministic outcome that it has to be like that. We can inform ourselves and have a rough idea that there will be a higher volatility, more or less of 0.4, 0.5% rising up on a 7, 21 and 63 days horizon. Okay, so you see here this, what is that? So of course this pound Canadian dollar, and it's completely bonkers. Also pound Swiss franc shows some rising conditional volatility in future, and also vis-a-vis this the Danish krona, a little bit less, 0.3% vol, conditional vol. Also pound euro, higher vol in the next 1 to 2-3 months, more or less, next quarter. Okay, so we are still always talking about what seems very minute scale numbers, like 0.4%, 0.5% conditional vol, but it's not as little as you may presume. Okay, here, okay, pound yen somewhat bit higher, 0.6 up to 0.8% in 63 days forecast vol, so could expect some higher vol. By no means is sure there will be higher vol. And NOK is a no. New Zealand, it's I don't know, but you see the charts are well, the 7-day chart, of course, there are just 7 data points, so it cannot be like a Picasso. But okay, this New Zealand dollar is very interesting. Okay, Swedish krona. So more or less all the FX pair, they will have trending higher vol, extrapolated from the GARCH models. We are in the range of, okay, we have a table here. That's very interesting. Here we are, you see. It's very, very interesting. Here we are. Okay, so we have everything. So model distribution tells us the P and the Q parameters. It tells us which model it has used automatically in the computer. If it was asking me, I would take ages to do that. So, and then it gives us a very interesting table because it tells us the average volatility, not volume, in 7 days. And we have the pound South African rand top of the league, 0.74. Mean vol 21 days, 0.76. Max vol 0.80. And the max vol in 63 days, 0.86. That's volatility. These are not the daily returns. That's the volatility. It's another parameter. It's what you will not find here. My idea, you will not find it here, my dear. It's not a good idea. Because it's these are the daily returns. So it goes up or down by something. But here we measure the volatility. So we measure the other parameter. And I will tell you again. So what you see here, my idea, is mu. Mu is not a cow, my idea. It's mu at time t, or time t plus n, n periods. What we measure here, my dear, is the sigma of the distribution of prices. Okay. The sigma here you don't find it because the price of the exchange rate is the average price, so it's mu. But the other parameter you need to calculate it, and I have it here. So the average, the Dow Jones moving average. Okay, we don't have pound dollar here. Okay, so pound yen. Okay, we have some parameters, and between 0.6 and 0.79 or 0.8 daily vol or max vol in a range that goes between 7 and 63 business days. Okay, so bear in mind the business day difference. And comparative forecast. Okay, so the cable, it has an average vol of 0.5%. Pound yen has average vol between 0.6 and 0.7. Pound South African rand is 0.74 to 0.8. Pound Mexican peso also is interesting, 0.62, 0.68. So it's a range that the less volatile are pound euro, pound Singapore dollar. You are in the range of 0.34, 0.37. Also pound Danish krona. Those are the less volatile, independent of the 7, 21 or 63 days. And it's here in the chart because we have these orange and red charts which are the euro and Danish krona, which are there is a huge gap between some currencies and some other currencies. Okay, so we have higher volatility in Asian currency, in Japanese yen, or the South African rand, or the Mexican peso, or maybe the Swedish krona, or a little bit the Swiss franc, or Swiss franc not so much. Yeah, the Swiss franc or the dollar. But pound euro or pound Danish krona or pound Singapore dollar, they are less volatile. The exchange rate is more stable. Okay, so we can build a lot of things. Now, here it's quite a difficult thing to talk about, because this goes into the Bayesian concept of statistics, which also works with the expected values of random variables like theta parameters, but never. And then basically it gives out the posterior mean distribution of the parameters, and estimates with the Monte Carlo simulation, etc., etc., etc. I will leave it as it is. We will not go through this one, but nevertheless, what is important is consider the new parameter and standard deviations, and basically compare it with the other currencies or the other volatility parameters, and you can basically see if the posterior mean distribution of the volatility it's more or less in line with the framework that you have with historical volatility, and that will basically inform your framework. It will make you aware of the probability distribution of volatility for financial asset. And in terms of volatility, then we want to know what is the VAR, so the value at risk, and we want to know what to expect if we have very high volatile business days or trading days. So in that regard, for that matter, we have the value at risk parameter, but we have a theory which is built around the value at risk, not built around, it supplements the value at risk, which is the EVT theory, which is not electric vehicle, which is extreme value theory, which incorporates the GPD Pareto distribution and the POT threshold, which is not pot threshold. As you naughty boy, you think pot threshold, you don't know what it is. So it is a peak over threshold. Okay, so if I have a volatility threshold, okay, of the 95th percentile, then the peak over this threshold, what are the extreme values that have been verified in 20 years of daily returns, so that I can identify those peak over threshold extreme value days when the market moves around by 2, 3, 5%. So the currency market is very, very risky and very volatile. Like you have a pound crash, you have a run on the pound. You have a run on the pound, and you can identify with the pot threshold, peak over threshold parameters, and you identify what are the extreme values. Here, for example, for a 99% value at risk. Okay, so yes, exactly. So let's take cable pound dollar. So the 5% probability of R95 that we have a 0.9465%, let's call it 0.95% move in a day. Okay, remember here the red line, it's the 99 var, the peaks over threshold, pot threshold peak, so it's a 95% parameter. The 95% parameter is the var 95 peak over threshold here. Okay, so don't be naughty and silly, right? Be a good boy, right? And peaks over threshold. So what happens? If the market, basically the pound crash more than 0.95% or goes up more than 0.95%, plus or minus, then we identify those periods or those days, because what we see here, like especially during periods of financial stress, we see that those very large daily returns, they are concentrated, they happen within the same span, same period of time. Okay, so the market was volatile during 2008, and we have a series of days when the pound has moved up or down by more than 1 or 2%. So it has moved, it has peaked over the threshold of 0.95%. Okay, so you have this, you have the parameter, in this case the line are on the positive side of the chart. Okay, so we can visually see what are the positive peak over the threshold in the extreme value theory, above the 95 or the 99th percentile confidence interval of the daily returns. We have the 5% of 1% probability that we have a peak over which threshold. If it's the 99%, so the pound has jumped up more than 1.57-58% in one day. So the pound moves more than 1.5% in one day. You have, you know that it's very rare, and there is a 1% probability that kind of move can happen. It doesn't happen every day. And yeah, we have there is the 0.1% probability, which is this big bar here or here or here, that the pound moves more than 3% in one day. So we are talking about huge moves. And the EVT, extreme value theory, it builds a case when you have a threshold, and it builds the case also with the GPD, generalized Pareto distribution, and basically you have the value at risk. But what if the market moves, it's very volatile and moves beyond what is my VAR parameter, my VAR numbers? You know, it's these VAR numbers that don't check in, don't check. If somebody else sees these VAR numbers, we may be too late. So, so you have the ES, the expected shortfall. Okay, so what builds basically the framework? So I have a peak, and the peak value it's 0.95 at the 95th percentile. Okay, 0.95%. So there is a 5% probability that the pound jumps or falls by 0.95% in one trading day, and I have to expect a shortfall of, I can expect an additional shortfall of 1.37%. So all in all, we go on a 2% move. Okay, so the expected shortfall basically builds the overall framework for very large moves, like up or down like at 8 or 10%. Okay, so I suspect that the VAR numbers have been rendered as a positive numbers, and the positive return have been rendered as negative numbers, that's for sure. If you follow me, because this is here it's oh yeah, okay, because here it's loss. Okay, so on the y-axis there is loss, so everything that you see above the orange and the red line, so these are the big days of pound crashing. In fact, here we have 2016, this big day of loss in the pound. It's a VAR 99.9. I have a threshold of 3.12%, and that's my peak. So the peak over this threshold is an expected shortfall of 4.4%. All in all, I mean for a 7.5% daily loss in the value of the pound, which it was well surpassed because the pound was down -8, -10%, and they were all cheering. So how strange and bizarre and peculiar can be the human being. That's the infinite wisdom of karma that will make you basically comprehend certain things. So the same is for each and every FX pair. And yes, the model basically builds on top of the value at risk all the parameters, the expected shortfall, so it gives you a threshold. You have here the density of the, in percentage terms, of the excess losses, like when you have again those very volatile days and then the market moves in such extreme manner of -3, -5, -2, whatever, and it's the curve, it fits a generalized Pareto distribution. And here pound yen, the VAR 95 already, it's 1.2%, the expected shortfall is 1.88%. So this kind of model builds up a framework for which is not of everyday shopping to go to the grocery shop, but it builds a framework of reference for when there is very high volatility, and of course you need to have a huge, very wide stop loss, and you can account for move in the order of larger of 1, 2, 3, larger than 4% in a day. Okay, but these are very rare events. They don't happen every day because currencies, they must be stable. But nevertheless, we see that the pound is normally, I mean, it's quite easy that it oscillates between plus or minus 2%. Okay, so the daily returns, they are volatile, and they can be used for speculation, of course. So we are very long in the tooth with this, and okay, yeah, we have an additional study, and here we have the epsilon parameter. And so basically what we see in the extreme value theory with this horizontal chart, the daily returns, we have some thresholds, the 95, 99%. We know what is the daily return in terms of very large value at risk moves and the expected shortfall moves. like here 0.98 or 3%, and expected shortfall 3.8%. So we have this, and so we store some very good things, but here we have it in a different way. We have a bell curve distribution, and as I said before, the pot threshold is not pot, but it's peaks over threshold. So here on a bell curve distribution, Gaussian distribution, the green dots are tail threshold. So the tail threshold basically defines exactly what falls within the 90% confidence interval. Yeah. Then what is in the tail distribution, it's everything that happens between the green dots and the red lines here, or from the green dots above or beyond the green dots. Those are the tail distribution of the bell curve. Okay. Now here for cable for pound dollar, we have a shape epsilon parameter of 0.189, and the tail threshold it's 1.15%. Okay. So above or beyond plus or minus 1.15%, you are talking about daily returns of pound dollar, which are in the tail of the Gaussian distribution, and the probability that you have daily returns above 1.15%, it's very, very small probability. It's a probability that goes from 5 to 0.0 something. Okay, so it's a very small probability, but nevertheless you have to account for the probability. And for example, the red line here, it's the VAR 95. Okay, so there is a 5% probability. So the tail threshold, I'm not sure it's the 90%. It's probably, I don't know. I don't want to say anything wrong. So the VAR 95 here, the tail risk analysis, it's a bit larger because, okay, let's compare it. Because here we are doing a tail risk analysis. So we take the Gaussian distribution and we do the tail risk analysis. Here, nevertheless, we have a 0.95 VAR 95 pound dollar, VAR 95 0.95, VAR 97.5 1.18%. Okay, that's the VAR framework with the expected shortfall. Now, if we take the same data of the pound dollar and we do a tail risk analysis, we see that we have a higher threshold. Instead of being 0.95, it's 1.15, and here we have a VAR 95 which is minus 2.64, which is here, and incredibly we have an expected shortfall that goes as far as minus 10.2%. And that data, I'm sure it's in the pound dollar exchange rate of 2016, because that's the Brexit crash. Okay, but nevertheless, that's another way of measuring what is the tail risk of currencies. And again, the tail risk, the currencies, can be very, very volatile indeed. And this Gaussian chart is very interesting. Here, for example, pound Japanese yen, we have an expected shortfall as large as minus 15.95%. I don't know if you can all read it. Make it a bit okay. Yeah. Expected shortfall minus 15.95%. So when we compile for a tail risk analysis of the daily returns of pound yen, we see that we have a tail threshold of 1.5%, the VAR 95 it's minus 4%, very far in the tail of the distribution. The expected shortfall is something out of sample, out of the distribution probably. Same is for pound Swiss franc minus 13%. These are very huge crash indeed, that they never happen, but they happen once every 20-30 years, so we can be very, very comfortable that is stuff that doesn't happen every day. Okay, yes, here we have a volatility forecast, and we run an analysis of what is the volatility regime, and if we run a forecast of 3-month volatility, and if there is a switch in the regime, we go from low, medium or high volatility, it depends. That can be useful, but as you all can see, the volatility forecast, it's difficult, it's not really attached to the trend here. Nevertheless, these are very like additional things that anybody can do and try to forecast the volatility. And I mean, that's it. Yeah, we have okay, so last but not least, in terms of trading, we can utilize a mean reversion strategy versus buy and hold. Okay, so if in the year 2000 I would been buying pound Aussie dollar and been holding pound Aussie dollar, my cumulative returns would have been 0.8%. While instead, if I use a mean reversion strategy, what is the mean reversion strategy? Is what we have been talking about all the times. So we have the average value, which is mu. Okay, so we find when the mean reversion strategy, it's when the exchange rate deviates here or here far from the average value. So we take a long or short position according to the mean reversion theory. So in simple words is that I know that the average value of the exchange rate of euro dollar, for example, is 1.10. Every time euro dollar moves away from 1.10, it goes up or down. After a certain time, I can play for mean reversion. Okay, let's do it in very simple terms. Also because I'm a bit tired now of blabbering about this thing. So the mean reversion strategy in terms of trading in the long term, it's more profitable than buying and holding a like carry trade of currency trading. Okay, so a simple method to do FX trading, it's using a mean reversion trading strategy, although it's not very profitable. We are talking about 1% cumulative return, so it's nothing more or less. So if we see the summary performance, okay, so what is most profitable here? Total return, if we use a for pound Norwegian krona, the total return of a mean reversion strategy is 50.75% based on the historical data. The annual return is 2%. The volatility is the strategy has a 5.77% volatility. Sharp ratio. While instead the buy and hold trade, it's not profitable at all. It's very little profitable, but you see big minuses here. The buy and hold trade, it's good for pound South African rand because it gives you 70%. I mean, it has provided 70% return in the past 20 years, from 2000 to 2025, so it's 25 years. So what to consider? We can see here pound South African rand, the buy and hold trading strategy, it has returned 70%. Okay, if we instead we consider the best performing strategy, the best performing FX pair, then we take pound Norwegian krona, and the Z-score or the mean reversion strategy, it returned on the past 20 years data, it returns 50%, or 40% for pound Aussie dollar, 37% for pound Swedish krona. Okay, so all in all, if I want to use a mean reversion strategy, I can use it with a good probability to have very good returns for pound Norwegian krona, pound Aussie dollar, pound Swedish krona, sorry. We are talking about between 37 and 50% return, although it's a 25 year time horizon, so it's an average 2% return per year, so it's not much, but nevertheless it's something. And so okay, that's all for today. I hope you enjoyed the video, and yes, thumbs up, leave a like, leave a comment, subscribe to the channel, and see you to the next